All right. Good morning, everybody. Good morning, all you magnificent melon heads, and happy Thursday, everybody. Today is September 28th, 2023, and the big story this morning is fear, extreme fear. It's back. That's according to the CNN Fear Greed Index. We finally dipped into the extreme fear territory. We haven't been here for 6 months, not since the banking crisis in March. You may recall all through the summer, we were in extreme greed territory as AI mania gripped markets and number went up, number go up every day. Well, that coin has now flipped and we are heading lower. Now, the question is, do we bounce here? We're at a point where historically we bounce. Markets don't usually stay in extreme greed very long. The problem is if they do stay in extreme greed very long, the floor falls out from beneath you and, well, there's a long way to fall. So we're going to look a little bit at what the market is fearful of, but more importantly, what is the market not fearful of right now? And it might surprise you. You see, virtually every category in the CNN Fear Greed Index is in extreme fear territory right now, except the spread with junk bonds. And the spread with junk bonds, that's referring to how much of a risk premium do companies that are more likely to go bankrupt, how much more expensive is it for those companies to borrow money versus some of their better rated counterparts, or versus, say, the interest rate on U.S. government debt, which is considered to be much lower risk. Well, right now, the spread for junk bonds is very low, which means if your company is about to go bankrupt, it costs you about the same amount of money as it would cost a company that is not about to go bankrupt. And, well, what does that even mean? How could that possibly be right? Because we've got a lot of this debt out there. There's a lot of these zombie companies that just won't exist for much longer if the interest rate on that debt doesn't get cheaper soon. And so I guess what the market is saying with this low spreads between junk bonds and AAA rated stuff is that they think the Fed is going to flip very soon. So this low spread on junk bonds, what they're really telling you guys is that the Fed is bluffing, that higher for longer is not going to happen. And that don't worry, guys. Money, Jay Powell, go Burr, zero interest rate policy is coming back any day now. The Fed is going to rescue all of these zombie companies. I'm not so sure that's a safe bet. It might be, but then again, it might not. We're judging this crisis and this situation based on the response to previous crises and previous situations like the GFC, like the dot-com, like the initial days of the pandemic. But you know what? In all of those prior situations, you know what? We didn't have historically high inflation. We do have that now. So this bet, it's bordering on arrogance among bond traders that, don't worry, the Fed's just going to turn on the money printer any day now. They're going to ride to the rescue. Are you willing to bet your life on that? Is that the hill you want to die on? Well, right now, the bond market is saying it is. And with that, we are going to shrink my big melon of a head. Sorry. And with that, we are going to shrink my big melon of a head. And we are going to get into a couple of these things. Now, guys, while we're shrinking my melon, won't you please hit that like button and subscribe to my channel if you're new here. We do this every day, and it really does help me out in the YouTube algorithm. Also, I just want to mention that this is a pre-recorded video today. I will be boarding a plane momentarily if you're watching this stream live. So all of these numbers that you're seeing right now are as of 6:37 a.m. Eastern time right now, because I had to do a pre-record today. I wanted to keep the content flowing. I wanted to have an update for you guys this morning, so I had to wake up a little earlier and do it so I could catch my plane on time and still give you guys something to watch while you're having your coffee. And the S&P 500 is currently set to open a paltry 5.8 points higher. Little bit of green. That's after another rough day yesterday. The Dow is set to open 43 points higher, up 0.13%. And the NASDAQ is the one index that's a little bit lower this morning, but only by 3 points. Again, guys, these times are as of 6:38 a.m. Eastern time. We've also got the U.S. dollar is a little bit lower this morning. The DXY, or the dollar as measured against other currencies, is at 106.39. That's down 28 basis points. That's after ripping higher yesterday. We're still a little bit higher than we were this time yesterday morning. So a stronger dollar continues to march higher. Gold currently at 1891. We lost that 1900 level for December gold futures yesterday. That's up $1 this morning. December silver futures trading at 22.77. That's up about a nickel or a quarter of 1%. Crude oil is at 93.28, down 40 cents this morning or 0.43%. Higher oil continues to be a thing. And looking over at the bond market, we've got a mixed bag in bonds at the moment, but interest rates have just been marching straight up. That is since last week with the Fed and Jay Powell's press conference. We've got the 30-year yielding 4.75%. That's up about 2.5 basis points this morning. The 10-year 4.645%, up another basis point and a half this morning. As the 10-year just keeps grinding higher, something has got to give here. Either we are going to get a flight to safety and these yields are going to head lower, or we're just going to keep grinding higher. And the problem, the credit risk will continue to mount. The 2-year yielding 5.129. That's down about 1 basis point this morning. And the 1 month is yielding 5.398. Check out this chart of the 10-year Treasury, guys. This is going back to about August of last year. We took out the high from last October. We took out the high from March. And now we continue grinding higher, currently at 4.64. When is the last time we were this high? Oh, we have to back up quite a bit to get to that one, guys. The last time we were this high appears to be something like 2007, October of 07. Prior to the GFC is the last time the 10-year Treasury was this high. Now, I want to point out this tweet. This was from Joe Brown at Heresy Financial yesterday. He put this one out, and Joe's making a pretty good point here. He's saying if we don't bounce here, we fall hard. And Joe's making a very good point. This is where we would historically bounce. There's a number of things going on here. Now, Joe posted this chart, and what he's doing, he's got this ascending level of support. He connected the dots from the prior two lows here. The first one was from back in October, and then the next one during the banking crisis in March. If you connect those dots and extend the line, you can see we are right at this ascending level of support. This is the trend line where the market would typically bounce. And the CNN Fear Greed Index back in extreme fear territory. This is also the point where the market would typically bounce. So markets typically bounce where they typically bounce. The problem is if they don't, they keep falling. And what Joe is pointing out here is your next support level is a whole heck of a lot lower than it is from here. So keep an eye on this. These next few days are going to be very important, guys. Do we catch a big bounce here or not? Now, here's the CNN Fear Greed Index in extreme fear territory at 24. I want to show you guys the timeline here. Going back to those prior two lows in October, it got down as low as 13 at the end of September. And then it was around 16 in October when the market made that low and bounced. You see, it doesn't stay in extreme fear very long. It came up, and then we hit another extreme fear level in March. That's following the collapse of Silicon Valley Bank. We were in the 20s there, but we bounced, spent all summer in virtually extreme greed territory, and now we've fallen pretty fast, most notably these last few days since J-Pow. So here we are back at this level where typically we would bounce. But I saw something interesting here. When you go through all the component indexes that make up the CNN Fear Greed Index, market momentum is in fear territory. Stock price strength, extreme fear territory. Breadth, extreme fear territory. Put to call ratio, extreme fear territory. All of these indicators that make up the CNN Fear Greed Index are in extreme fear territory. Market volatility, safe haven demand, extreme fear, all except for one. Check this out. Junk bond demand. The yield spread between junk bonds and investment grade bonds, they're actually in extreme greed territory. Say what now? With interest rates at highs we haven't seen since the GFC, the bond market is pricing in a lower risk premium for garbage debt than really it's ever done before. The spread is historically low for junk bond debt. And the only thing I can think of, anybody knows that these companies that are hopelessly dependent on debt, that if something doesn't change, if interest rates don't drop, that these companies are dead. So the fact that nobody is afraid of that right now in the junk bond market tells me that everybody is betting that the Fed is coming to their rescue. Nobody cares how risky these companies are because J-Pow go burr. That's what they're telling us. And you can see the same thing on the CME's Fed Watch tool where the odds of a November rate hike, even though last week Jerome Powell told us he is almost certainly going to hike in November, you've still only got a 22.4% likelihood of a rate hike in November. He just told us he's going to do it. And 4 out of 5 people are still betting that he won't. This, to me, is moral hazard. This is the market saying, it's okay. They're just going to print more money. They're just going to steal wealth from existing currency that is sitting in people's savings accounts, and they're going to give it to us to bail out our bad bond bets. That's what the market is saying right now. I'm not sure that's a safe bet, guys. Historically, it's been a good bet. It's been sleazy and it's been unethical. But are you sure you're going to do that? Is that really the hill that you want to die on? Check this one out in Barron's. Junk bonds have outperformed in a dismal bond market. It's time to get nervous. Barron's is warning here that they're just being way too greedy in the bond market. It's the one sector, extreme fear everywhere, except the people who are lending money to the riskiest companies. They're very confident. Junk bonds have been a bright spot for bond investors in a miserable 2023. They have looked riskier than they did. They also look riskier than they did earlier this year. And check out some of this stuff. Appetite for riskier deals increased this year as the economy's resilience amid historically high interest rates suggested companies would keep defaults at bay. The recent record low maturity of high yield bonds, now at just under 5 years on average, compared with more than 8 years for investment grade, is a selling point for investors who have favored short-term investments this year amid rate uncertainty. So the thing is, most of this high yield junk debt, it matures sooner than the more investment grade stuff. And the bond investors actually like that better, I think, because they project maybe there's less risk of interest rate swings in the future. And so they like that short-term maturity. But that's not entirely a good thing. Part of that low maturity is a response by new issuers who offered reduced duration counting on rate cuts and lower yields. That's in the future, but also the short supply of new high-yield bonds. See, it's been too expensive to borrow, so a lot of companies aren't borrowing. That's limiting supply. Companies issued just $130 billion worth of high-yield bonds so far this year after issuing just $102 billion last year, two of the worst years for supply since the 2007 to 2009 recession. PitchBook LCD data shows issuance has averaged $284 billion over the past decade. So they've been only issuing about half of the average junk debt for the last 2 years. Although supply improved in September, the overall low issuance has meant investors have been buying what's been available, and that's keeping demand high. So it's not so much a demand thing as it is a limited supply thing. It's keeping prices higher because they've been cutting the issuance of new supply because it's been more expensive to borrow this stuff. But buyers may want to dial down their optimism. The Federal Reserve has committed to keeping interest rates higher for longer, which should cause the U.S. economy to weaken and weaken highly indebted companies, leading to more defaults by these speculative grade borrowers over the next year. Even historically short maturity window could be problematic if companies are forced to borrow money at higher interest rates when their current bonds mature. And what's more, the extra yield investors are getting to buy junk bonds just isn't compensating them for the extra risk. So what they're talking about here, guys, is this short maturity, the fact that most of these junk bonds, because none have been issued for the last year, a lot of them are going to mature very soon. And apparently the bond market likes that. That may not be a good thing because a lot of these companies can't pay back that money. And so the only way they're going to be able to roll over that debt is to take out new debt at a much higher interest rate that they may not be able to service. And the bond market right now is in extreme greed territory when it comes to the spread, the premium that it's charging to lend money to these risky companies versus the not risky companies. And this Barron's article is warning, guys, that enthusiasm, you may want to tamp it down a little bit because I'm not so sure this is going to hold up. The bond market, everywhere else in the market, extreme greed territory, but the bond market is still in extreme greed territory. And the CME futures are saying the bond market is betting that the Fed is going to ride to the rescue. Careful, guys. Be careful. Elsewhere going on this morning, we got China. Evergrande shares are suspended again after reports of the founder's disappearance. Chairman Hui Kai-yan has been placed under police surveillance, according to media reports. Trading in shares of China Evergrande Group and two of its publicly listed units was suspended on Thursday after reports that the beleaguered property developer's founder and chairman had been placed under police surveillance. Hui Kaiyan, who is also Evergrande's controlling shareholder, was taken away by Chinese police earlier this month and is being monitored by authorities. A domestic Chinese media outlet said Hui was being held at a location in Beijing. He hasn't been formally charged with any crimes. The developer's Hong Kong-listed shares, as well as those of its property services unit and electric vehicle manufacturing business, were all halted from trading on Thursday. They recently plummeted to multi-year lows. Now, guys, Evergrande Group had been suspended for over a year previously. Trading just resumed in August after more than a year suspension. Since trading resumed in August, Evergrande shares are down 81%. And now it's suspended. Well, it's suspended again. It was suspended for over a year. They bring it back, drops 81%, and then we suspend it again. I think that went well, don't you? That's very good. Also, China is taking all their pandas back. I don't know why I included this story. I just thought this was hilarious. All the pandas in American zoos are being taken back by China. After next year, the U.S. won't be home to a single panda. U.S. holds out hope for the charismatic megafauna's return. This story is ridiculous. China's taking their ball and going home. They're taking back all the pandas from American zoos. It's a low blow, China. You can lob missiles. You can do a trade war. You can debase your currency. Don't mess with the pandas, man. Come on. Also, in ridiculous stories this morning, Peloton shares soar on digital content and apparel partnership with Lululemon. Peloton and Lululemon announced a 5-year strategic partnership. Peloton will develop digital fitness content for Lululemon, while Lululemon will become Peloton's primary athletic apparel provider. And that's good because exercise bikes, most people buy them and just end up hanging clothes on them. Well, now you can exclusively hang your Lululemon clothes on your overpriced exercise bike that you bought, paid way too much for, used once, and then turned it into a clothes hanger. Lululemon plans to discontinue sales of its Studio Mirror product before the end of the year. Now, here's the real kicker, guys. Peloton stock, look at this. It's up 11.4% right now. Again, that's as of 6:50 a.m. Eastern time. 11% jump in Peloton shares on this news that they are going to be able to offer their content on the Lululemon app. No details about this. No money changing hands that we know of. Just, okay, we got a partnership with Lululemon. So overpriced exercise equipment company makes exclusive deal with overpriced exercise apparel company, and the stock goes up 11%. All right, good luck with that. If you guys are buying Peloton shares on this news, good luck to you. You're probably better off with the spreads in the junk bond market. And we got something else that just hit the tape a few minutes before I went live. I don't really have much more on this one. GameStop names Ryan Cohen as CEO effective immediately. Heads up, all you banana-loving apes out there. Ryan Cohen was already GameStop's executive chairman. He's now the company's CEO. The move comes more than 3 months after GameStop fired then CEO Matthew Furlong. Shares of GameStop jumped after the announcement. GME shareholders just love Ryan Cohen, currently up 10% pre-market. So good luck to all of you GME shareholders. Hope you guys are doing well. All right, guys, I just want to say thank you very much. Once again, this is a recorded one, guys, so I can't read any of your super chats, but I will be in the chat below, so I will respond to you in the chat for there. Say thank you very much to all of my Patreon supporters for everything you guys do for the channel. Had a great time talking to you yesterday on our Zoom call. Link down below should you feel so inclined. I'm getting on a plane. I'm heading to Las Vegas, Caesar's Palace, the Silver Symposium. It starts tomorrow. Link down below if you still want to get your tickets. If you use that affiliate link, you'll get 10% off. Hi, Mom. Hi, Dad. Till next time, live small and dream big.